Welcome to Ray Dalio Warning. Please like, subscribe, and share.
What if I told you that the cash sitting in your bank account right now is quietly losing its power to protect you? Ray Dalio, the billionaire founder of Bridgewater Associates, the world's largest hedge fund, has issued a stark warning. If you're not holding precious metals by 2026, you could be on the wrong side of the most significant wealth transfer in modern history. While most investors chase stocks and bonds, Dalio is positioning for something far more fundamental. And if he's right, the consequences of ignoring this warning won't just sting, they'll reshape your financial future. Ray Dalio isn't just another talking head on financial television. He's the architect of Bridgewater Associates, managing over $150 billion in assets, and he's correctly predicted major economic turning points from the 2008 financial crisis to the inflation surge of the 2020s. When Dalio speaks, institutional investors listen. And right now, he's sending a clear signal. Traditional safe havens are failing, and precious metals, specifically silver and gold, are becoming essential for wealth preservation. In this video, we'll break down exactly why Dalio believes 2026 represents a critical inflection point, what forces are converging to make precious metals indispensable, and how his investment philosophy demands a fundamental shift in how you think about protecting your wealth. This isn't about speculation or getting rich quick. This is about understanding the economic machine that Dalio has spent decades studying and positioning yourself before the rest of the world catches on. To understand why Dalio is sounding the alarm on precious metals, you need to grasp his concept of the long-term debt cycle. In his book Principles for Navigating Big Debt Crises, Dalio explains that economies move through predictable phases spanning 75 to 100 years. We borrow, we grow, we over-leverage, and eventually the debt becomes unsustainable. When that happens, governments face a choice: default on obligations or devalue the currency through money printing. History shows they almost always choose devaluation. Think of it like this: if you owe someone $100, but you can legally print dollars, you don't default. You just make those dollars worth less. The creditor gets paid back, but the purchasing power evaporates. This has happened repeatedly. Weimar Germany in the 1920s, the United States abandoning the gold standard in 1971, and more recently, the massive money printing during the pandemic era. Dalio's research shows we're now in the late stage of the current long-term debt cycle. Global debt has exceeded $300 trillion, over 350% of world GDP. Central banks have printed trillions to manage crises, and inflation has already proven more persistent than authorities predicted. This is exactly why Dalio's warning matters now. The endgame of debt cycles historically destroys currency value, and precious metals are the assets that survive, even thrive, in that environment. First, Dalio believes the massive debt burden carried by governments worldwide will inevitably lead to currency debasement, and this process is already underway. The numbers are staggering. The U.S. national debt alone surpassed $36 trillion in 2024, with annual deficits exceeding $2,000 trillion. Interest payments on this debt now consume over $1 trillion per year, rivaling defense spending. This isn't sustainable, and policymakers know it. Here's the mechanism: when debt grows faster than the economy, governments face a painful dilemma. They can raise taxes, politically toxic. They can cut spending, also politically toxic. Or they can inflate away the debt by keeping interest rates artificially low while allowing inflation to run higher than those rates. Real interest rates go negative, meaning savers lose purchasing power while debtors benefit. Dalio has explicitly stated that cash is trash in this environment. When central banks maintain negative real rates, meaning inflation exceeds what you earn on savings, your dollars are depreciating assets. Between 2021 and 2024, U.S. Inflation cumulatively eroded over 20% of purchasing power. If you held all 100,000 in cash during that period, your real wealth fell to roughly 80,000 in terms of what it could buy. So what happens if this pattern continues or accelerates into 2026? This means if you're holding significant cash positions or relying heavily on fixed income investments paying below inflation, you're essentially guaranteeing wealth destruction. You're working hard, saving diligently, and watching your purchasing power evaporate. But here's the twist: while paper currencies can be printed infinitely, gold and silver cannot. These metals have been money for 5,000 years precisely because they're scarce, durable, and can't be conjured by governments desperate to finance spending. When confidence in paper currencies declines, as Dalio predicts it will, investors flood into assets that maintain intrinsic value. Gold and silver become the refuge, and history shows their prices surge during these transitions. But here's where it gets more complex. On top of currency debasement, the global monetary system itself is fragmenting, and precious metals are being positioned as strategic assets by nations preparing for a post-dollar world order. In his book Principles for Dealing with the Changing World Order, Dalio documents how reserve currencies eventually lose dominance through a predictable pattern. The British pound ruled for over a century before the dollar displaced it after World War II. Now, the dollar's share of global reserves has fallen from 70% in 2000 to under 59% today, the lowest level in decades. Why does this matter for you? Because as trust in the dollar erodes, countries are diversifying away from dollar-denominated assets. Central banks worldwide have become net buyers of gold at levels not seen in over 50 years. In 2023 alone, central banks purchased over 1,000 metric tons of gold, the second highest annual total on record. China, Russia, India, and Turkey are aggressively accumulating gold reserves while reducing dollar holdings. This isn't random. These nations recognize what Dalio has been warning about: the weaponization of the dollar through sanctions and the inevitable consequences of U.S. fiscal recklessness create risks they want to hedge. If the dollar's reserve status diminishes, even gradually, the implications are profound. The U.S. has enjoyed an exorbitant privilege where it could print dollars and the world had to accept them. That privilege is fading. Dalio has stated that we're witnessing the early stages of a shift comparable to the 1930s and 1940s, when geopolitical tensions coincided with monetary system breakdown. During that period, gold was revalued from 20 LR to 35 per ounce, a 75% increase as governments restructured the global monetary framework. The evidence is mounting. Various nations are exploring alternatives to dollar-based trade settlement. The IMF's special drawing rights are being discussed as potential supplements or replacements for dollar dominance. And meanwhile, individual investors in the West remain dangerously underweight in precious metals, with most portfolios holding less than 2% in gold or silver, if any at all. So far, we've seen that currency debasement erodes cash value and that the dollar's global position is weakening while central banks hoard gold. Both dynamics point toward the same conclusion: precious metals are transitioning from speculative assets to strategic necessities. And that's not even the scariest part. The scariest part is the speed at which these transitions can happen once confidence breaks. Now, here's the critical insight that separates Dalio's approach from conventional wisdom. While gold gets the headlines, silver may offer the most compelling opportunity, and your portfolio structure determines whether you survive or thrive through what's coming. Let's start with silver's unique position. Unlike gold, which is primarily a monetary metal, silver serves dual roles: monetary asset and industrial commodity. Over half of silver's demand comes from industrial applications, solar panels, electronics, Medical devices, electric vehicles, the green energy transition alone is expected to consume dramatically more silver in the coming years. Yet silver mining has stagnated with supply growth barely keeping pace with demand. This creates explosive potential. The gold to silver ratio, how many ounces of silver equal 1 ounce of gold, currently sits near 81. Historically, this ratio has averaged 51, and during precious metal bull markets, it's compressed to 31 or even 51. If history repeats and silver outperforms gold as industrial demand surges while monetary demand increases, we could see silver prices triple or quadruple, even if gold only doubles. Dalio himself has noted that while gold is the traditional safe haven, silver offers asymmetric upside when inflation and industrial demand converge. It's more volatile, yes, but that volatility cuts both ways. And right now, silver appears undervalued relative to both gold and its own historical averages. Now, let's talk about portfolio construction using Dalio's principles. His famous all-weather portfolio is built on diversification across uncorrelated assets to survive any economic environment. But Dalio has consistently emphasized that in environments of currency debasement and geopolitical uncertainty, precious metals become essential components, not optional additions. Imagine it's December 2026. In one scenario, you ignored the warnings. Your portfolio is 60% stocks, 40% bonds, 0 precious metals. Stocks have struggled as persistent inflation forces central banks to maintain restrictive policies, dampening growth. Bonds have underperformed as yields remain below inflation, eroding real returns. Your portfolio's purchasing power has declined 15% despite nominal gains. You watch gold and silver soar on the news screens, kicking yourself for not acting when the signals were clear. In the alternative scenario, you allocated 10-15% of your portfolio to precious metals split between gold and silver. When inflation remained elevated and geopolitical tensions flared, precious metals surged. Your gold holdings rose 40%, and silver jumped 80% as industrial demand combined with monetary flows. These gains offset losses in other asset classes, and more importantly, they preserved your purchasing power. You're not getting rich, but you're protecting the wealth you've already built. That's the difference between foresight and hindsight. Dalio's framework isn't about betting everything on precious metals, it's about balanced risk management. He recommends that investors hold between 5-15% in gold and consider silver as a more aggressive satellite position. The exact allocation depends on your risk tolerance and conviction, but the principle is clear. Zero exposure to precious metals in this environment is a bet that the debt cycle resolves peacefully and currency values remain stable. History suggests that's a bad bet. The window to act is narrowing. As more investors recognize these dynamics, as mainstream portfolios begin rotating into hard assets, prices will adjust rapidly. By the time financial media is screaming about precious metals, the easy gains will be gone. The informed move happens now, before consensus shifts. Ultimately, what does this all mean? Ray Dalio's warning about precious metals isn't rooted in speculation or market timing. It's grounded in his deep understanding of debt cycles, monetary history, and the mathematical inevitability facing over indebted governments. Currency debasement isn't a possibility. It's the path of least resistance for policymakers trapped by unsustainable debt. The dollar's diminishing reserve status isn't a conspiracy theory. It's reflected in central bank purchases and shifting trade patterns. And silver's dual role as monetary asset and industrial commodity creates a setup that only emerges once or twice per generation. These insights connect directly to the question we opened with: what happens to the cash you're holding? In Dalio's framework, that cash is a melting ice cube. It looks solid today, but it's shrinking with every month of negative real interest rates. The solution isn't to abandon all cash or go all in on any single asset. The solution is intelligent diversification that acknowledges reality. We're living through a monetary regime change, and your portfolio needs to reflect that. In short, Dalio's message is this: understand the environment you're operating in and position accordingly. We're not in a normal economic cycle where traditional stock bond portfolios suffice. We're in the late stage of a long-term debt cycle where governments must choose between defaults and debasement, and they're choosing debasement. In this environment, precious metals aren't speculative gambles, they're insurance policies with upside. If you prepare now, if you allocate even a modest portion of your portfolio to gold and silver while they remain undervalued relative to the risks ahead, you could preserve your purchasing power and potentially generate significant gains as the transition unfolds. If not, if you cling to the belief that this time is different or that policymakers will somehow resolve decade-spanning debt problems without consequences, you're setting yourself up for regret. Not panic, not catastrophe, just the slow erosion of wealth that comes from being positioned for the world we wish we had instead of the world that exists. Dalio's overarching philosophy has always been about radical truth and radical transparency. Face reality. Diversify broadly across truly uncorrelated assets. Understand that economic machines follow patterns, and we're in a pattern that historically favors hard assets over paper promises. Gold has survived every monetary experiment in human history. Silver has played both monetary and industrial roles through countless cycles. Your cash, your bonds, your stock certificates, these are claims on systems built on unprecedented debt levels. The knowledge is yours. Now it's about execution. The difference between those who protect their wealth through the coming transition and those who don't won't be intelligence or luck. It will be the willingness to act on uncomfortable truths before they become obvious to everyone. What's your take on this? Are you positioned for 2026? Do you believe Dalio's analysis, or do you think precious metals are overrated? Let us know your perspective in the comments below. I rate them and we'll discuss the best insights in our next video. If you found this breakdown valuable, subscribe for more deep dives into the world's top investors and the principles that guide their decisions. We cut through the noise and focus on what actually matters for your financial future. Next time, we'll explore Dalio's specific recommendations for navigating the debt crisis endgame, including the assets most people are completely ignoring that could offer protection. You won't want to miss it.
Thank you for watching. Please subscribe.